What is going on, best ever listeners? This is Matt Faircloth, and welcome to the Next Level CRE segment. Like I said, my name is Matt. I'm coming at you every Friday. So mark your calendars, Fridays for Next Level CRE. We talk about all the things next level to go business next level, life next level, all the next level that you want to go. That's what we discuss on this show. Guys, I want to pull out the best ever toolbox for you real quick. The best ever toolbox inside it. I've got this toolbox sitting here on my desk, proverbially, right? And inside this are all the different ways the best ever can help you get yourself to the next level. And the one thing I want to tell you about today that's sitting here in this toolbox is the best ever community. Okay. It's free. That's right. You got to qualify, and that's okay. But if you've done a few deals, if you're on your multifamily or your self-storage or your commercial road of real estate investing, you're on the road and you certainly will qualify to be a part of the best ever community, right? You could join right now. Like I said, it's free by going to bestevercre.com/community and engage in the. I was just in a great back and forth with somebody in the community this week talking about rates, multifamily terms, those kinds of things. And best ever listeners, you guys get to watch this show live. So if you feel so inclined, you can join, even ask questions for people like my guest today for things that we talk about all things real estate investing. So consider going to bestevercre.com/community. All right, I'll put that back in the toolbox, and I'll be pulling out this toolbox every here and again to tell you about things that Best Ever can help you get to where you guys want to go, because that is what it's all about. Guys, I've got a great guest today. We talked offline a little bit, a little banter. I'm excited for today's conversation for some of the topics we're gonna hop into. Welcome, Best Ever listeners, our guest, Jonathan Nichols. Jonathan, how are you today?
Doing well, Matt. Excited to hang out with you for a bit here.
Too. Guys, Jonathan joins us from Apogee Capital. Jonathan, don't give me the whole origin story. Hey, get involved in real estate investing. It's probably when you read Rich Dad, Poor Dad like 10, 15 years ago, something like that. I don't need all that. Tell me what Apogee Capital is, where you're focused. Give me like the brief rundown of the company, and we'll hop in to where I want to go, which is finding deals. But before we get into finding deals, tell me all about Apogee real quick.
Yeah, that sounds great. So I'll skip the Rich Dad, Poor Dad part of the story. But
am I right? Was I right about that?
You're spot on. You know, of course you are. You know, you had a 90% chance of hitting it on the nail on the head. So, no, like many of your listeners, my wife and I, we started investing in single family real estate many years ago. Had some success with it, so much so that we wanted to start this as a business. We wanted to scale and do real estate investing full time. If you know anything about my background, I worked as an engineer. I'm a very technical numbers kind of person. I'm not a hands-on painting person. I'm not a managed tenants person. But I am a very analytical, technical type of individual. And so when I came across multifamily, it seemed very exciting to me because I felt like it was an opportunity to use the best of my skill sets in the investing world. And kind of bypass or hire out, a lot of the other things that I wasn't so good at. And so we came across multifamily kind of during the COVID era. That's when we had a lot of downtime and, time to jump in and really learn about it, start buying some properties. And so some people might say that was a bad time to get started. For us, it was perfect.
Yeah.
And, now about half a decade in, it's hard to believe it's been that long. We've done a number of syndication projects. We live in Dallas-Fort Worth area of Texas, and buy multifamily all across Texas and Oklahoma. So that's the short summary.
Okay, so a few things to unpack there. You and I have a lot of similarities. Number one, you and your wife got started by investing together in that, and that's something my wife and I did 20 years ago. And then that we've been doing this for forever and a day. But also, you are probably the 2-3 dozen recovering engineers that I've met, including myself. Where'd you go to college?
At A&M, which ironically, I'm actually sitting in one of the campus buildings today, visiting one of our properties here. So yeah, I don't come back often, but yep.
I'll tell you, A&M, let's see, I went to Virginia Tech, and A&M, I recall that we beat A&M in the Sugar Bowl at one point, many years ago, I believe. It wasn't UT, it was A&M. Yeah, did a little trash talking, although we've never won a national championship. I think you guys won a few, But,
unless I leave it on the short side, I actually I did my master's degree in engineering actually from Virginia Tech. So
really,
we can bond on that. Yeah, it was
just brothers from another mother, you and me.
Yep, exactly. So did that while I was working full time. obviously Virginia Tech's great school, a lot more beautiful in Virginia, quite frankly, than here. But
not quite as hot. Yeah.
Not quite as hot, but that's beside the point. Yeah, recovering engineer and but still can't get away from all the numbers stuff.
Okay. And that's why, that is one initiative. Now, there's one guy, I don't know if he's around anymore. He was running a podcast for engineers because he realized that there were so many folks that are full-time real estate investors like you and I that either went to school for engineering or are still engineering on the side or whatever it may be. And so best ever listeners, if any of you guys are engineers or trained as such, Jonathan and I can commiserate with you on what I lovingly call being a recovering engineer. Because engineering can kind of get into your brain and you have to destructure it a little bit. But there's also like gifts I got from engineering. Like you said, the financial analysis, the problem solving mindset that engineering gave me, which I bring to daily to the real estate investing business, because there's always a problem to solve in real estate investing, isn't there?
Agreed. Risk mitigation is a big one I always bring up. Everything engineering is about understanding and reducing risk, which is a big part of investing.
Absolutely. So I wanted to unpack with you on the idea of finding good deals, because I got to tell you how many the best ever listeners that I've talked to offline, Jonathan, and just folks I've met in real estate circles and online and the best ever community. They're like, that is probably the challenge, and there's one of the two. So either finding deals, finding money, or making the deals work once you have them, right? You seem to have some creative strategies, as we all have had to do in finding deals. What are some of your secret sauces that you've got in finding the opportunities for your company these days?
Yeah, I'll give you a few things that I think are valuable, and no surprise because we're in a dynamic industry. It's changed over time. So I'll talk a little bit about kind of how that timeline it's evolved some. The first thing that I'll mention, though, it might sound like a bit of a tangent, but I think it's important, is that before you can go find a good deal, you have to know what a good deal is. And that's really where like the community you were mentioning is extremely valuable, because oftentimes I'll have people come ask me and you're like, hey, I can't find any good deals. And the first question I always ask is, would you know one if you saw one? And so, understanding how to underwrite, understanding how to look for value, it's not, a lot of people think it's just look at an OM and the broker's value add opportunity and you're going to have a deal. And there's a little more to it than that. So I'll start with kind of that caveat that if you don't know how to identify a good deal, you need to get that solved first. I'll tell you.
So, Jonathan, I can't just wait for when a broker emails me a deal. That doesn't mean I found a deal.
No. No. I mean, you found a property. You may not. You may or may not have found a deal.
Opportunity, but it's probably it may not be a good deal, right?
Yeah.
Okay. So underwriting guidelines, those kinds of things. Number one, right? So kind of knowing even like what your buy box is a huge factor, because like, how do you know what a good deal is? What is a good deal? Well, what is a bad deal for you?
Yeah. And I think a lot of that, obviously there's the whole knowing the numbers, the assumptions, using the spreadsheet. Mm-hmm. A lot of it comes down to knowing where there are and are not opportunities to add value on the real estate.
Yep.
And, being able to pick that out and be confident that you can implement that business plan, right? You and your property manager can implement that business plan. That's definitely a big component of it beyond just understanding the spreadsheet and the assumptions in it. To kind of pivot a little and talk about kind of how we've found deals and how that's evolved over time. Like I said, we got started kind of that tail end of COVID timeframe.
Yep.
And the market was very hot then. And, from there till about the first part of 2022, it was extremely difficult. As in, like, we live in Dallas, I mentioned, and I would go tour a deal in Dallas and show up and they'd be like, hey, unless you want to do 2% hard earnest money day one and you have an offer north of the whisper price, like you're wasting our time. And like I heard that on so many different tours. And so, it would have been easy just to kind of give up then and not do any deals, but we pivoted a little. We started to become experts on a few different tertiary markets around Texas and Oklahoma. So instead of just relying on deal flow from Dallas, we began to look at other markets where it wasn't necessarily easy to find deals, but maybe it was possible, or at least to find something we were comfortable with. And, one of our big criteria when we first started is we were trying to find deals where we could get long-term fixed rate debt. And so that pretty much prohibited any deal in the really hot markets like DFW. But we were able to get several deals done in markets like Tulsa, Oklahoma, College Station, where I'm sitting today, Oklahoma City, markets that still have a lot of the strong metrics that we look for as investors, but just weren't heated up to the point where you had to use high leverage bridge debt just to buy a stabilized deal.
Sure.
And so that was kind of how we did our first 2 or 3 in that time frame.
I got to tell you, Jonathan, if you're using even bridge debt's come down a little bit, but if you're using bridge debt to buy something that's leased out at like 85% occupancy or above, you probably got the wrong deal.
Yeah.
Like if your deal doesn't work with agency debt above 85%, that's just not the right opportunity, because back in the day, Jonathan, I say back in the day, like 5 years ago, like just right post COVID, where you could count on rent increases at 10%, you could underwrite for that. And that probably was reality. So you could grow into a deal. Let's say that. Growing into a deal ain't gonna happen anymore, guys. If your deal doesn't work at agency debt day one at above 85, forget it. I see bridge debt being applied. I knew you have a deal that you probably did use bridge debt. I'd have to think that you used something creative for some of the below 85% stuff. Before I get to the specific deal that you have, I can't wait to hear more about. Are you going direct to seller? Are you just tapping into broker networks and all these markets that you're looking at here? Like, how are you getting your eyes on the opportunities?
Yeah, so we're strictly broker relationships. So we don't do any direct to seller. No other type of leads. Strictly broker relationships, and that's been the source of all our deals.
Have you tried
direct to seller?
Yeah,
we have not. Never have. Maybe we should, but we have not.
No, not for nothing. We did, and it didn't work. And so, best ever listener, if any best ever listener is listening right now, put a note in the best ever community and tag me in it, because I would love to have you on the show. Like, that's an offer to the best ever community. I'll bring Jonathan on. Me and Jonathan will interview you direct. Like, how'd you do it?
Yeah, we want to know, especially if it's over 40 units, because I feel like the 8 unit, the 16, you still have the mom and pop owners, right?
World. That's like you're just a bigger wholesaler at that point, right? If you're doing direct to seller, and I see so many people direct to seller on single families, duplexes, even quads, and as you said, 10s or whatever. It's a whole nother world going direct to seller above 40. I've heard of people claim they're doing it. And I'll bet you there are people doing it, Jonathan. So maybe if I can get them to come up here, we'll have a good conversation with them. But best ever listener, if you're doing it, write a note in the best ever community and tag me and Jonathan in it. Until then, you're doing it like what most of the folks are doing, Jonathan. You're tapping into the broker network, right? And in these markets, how do you get brokers to take you seriously? Like to like, how do you get your name to stay at the top of their proverbial Rolodex?
Yeah, so I think there's kind of 2 questions in one there. First, it's like, how do you get them to take you seriously when you're brand new, right? And I think with that, there's really 2 strategies that you can do. One, you can sort of build your way up, so to speak. So, maybe you own some single family like I did, a quadplex or an 8 unit or something. Well, then if you're going to a broker and saying, hey, I want to buy a 30 unit, an 8 unit to a 30 is not such a big stretch. And so it's very easy to show, hey, we've come this far. The 30 unit's not a big leap. We're a qualified buyer, right? The harder stretch is if you want to go from the 8 unit to like a 100 unit deal. And I would say probably your best bet then is partnering with a very experienced sponsor in a co-GP type of role. And you can do a number of different things on that deal. You can, first of all, you could find the deal and bring it to the experienced sponsor. I would say that's not quite as common because most sponsors kind of have an idea of what they're wanting or looking for. But then you can partner in an active role with that sponsor and bring value to their team, take some of the work off of their plate, and become a partner on that deal. And then at that point, you can go to a broker and be like, hey, I was a partner with Mr. Matt Faircloth on such and such deal, and now I'm ready to go do my own deal, and here's what I've done. And so that's probably the second way you can break in as a new person. Ongoing, if you're an experienced sponsor, the way you get brokers to take you seriously is do what you say. You sign a contract, you close the deal. You say, I'm going to put in the LOI this week. You put in the LOI this week. And it sounds simple, but, brokers are very busy. They have a lot of wasted time. And the more they feel like you're not kicking tires and wasting their time, the more that they're going to take you seriously and give you opportunities that others might not get.
It's funny, Jonathan, because like the reason why you're bringing this up, and it's a fact, it's true. It's simple integrity. Crazy thing, guys. Do what you tell people you're going to do. Like underline that, right? But the bottom line is like a lot of people don't in this industry, right? Like, oh yeah, broker, I'll make you an offer. And then you underwrite the deal and it doesn't quite work out to your numbers. So you just stop calling the broker back and you just let it go, right? Well, are they going to take you seriously? Probably not, because you blew them off. You know, you led them down the road and then they're like, oh, whatever. People forget a fact. And the fact is that these brokers are feeding their family with the deals that you're going to be doing with them. With that commission, they're maybe not going to buy themselves their third Porsche or their third Ferrari or whatever it may be. Maybe they're going to just put food on their table with it, and just maintain their business or whatever it is that they're maintaining, right? So it's their livelihood, to say it simply, right? And you're messing with their livelihood if you come in and mess around with them, like you said about losing integrity, whatever. They're going to take you seriously if you take them seriously. Maybe bottom lining, right? So love that. I found Jonathan, I'm sure you do this too. A broker's phone probably rings 7 or 8 times an hour. And back in the day, in the early 2020s, they're probably getting 7 phone calls an hour with like, hey, I want to buy a multifamily. Right? I'm sure it's cooled down a little bit from then, but like they get a lot of people reaching out to them. And so if you didn't say out of sight, out of mind, what I've told people is if you're not calling that broker that's in a core market that you're in, that's one of the key brokers that gets a lot of transactions in that market. If you're not calling them every other week, somebody else is, Jonathan is,
Yeah.
So you got to keep up with your competition, right? I mean, how often do you reach out to your brokers?
Pretty regular. Yeah. I mean, I think, every other week is probably reasonable if you're in active like acquisition mode. And one of the things that I would add is like, we talk about broker relationships. It's a relationship. And so, I probably know because I'm in several different markets. So there's a lot of brokers across those markets. And I know, a large percentage of them have somewhat of a relationship, but there's a handful of them, let's call it 6 to 8, that they're legit my friends. Like, I'm going to go drink a beer with them or go eat dinner with them, not with some kind of, underlying expectation, but just because they're my friends and I hang out with them. Right. And so broker relationships is really a relationship. It's nothing more complicated than that, but it does take time to build those.
Best for listeners, you don't have to all go and have dinner and beers with your brokers. It's not going to hurt, but develop a level of trust with the broker to the point where you could, right? The point where you're at that level of trust with them, and they don't have to be buddy. You have to send them birthday cards and everything, but they've got to trust you to the point where they're going to trust you with their livelihood. Like, I'm going to call Jonathan because I got it. And here's what's going to happen. We're going to get to this deal right now. You're going to get a screaming hot deal. That's a distress deal. And the broker's like, okay, I got 2, maybe 3 people I can call. Deal's got to close in 30 days. It's a hot off the press deal. Don't have time for lots of marketing and, 20, 30 boots on the ground, that kind of thing. Don't have time for all that. I need somebody who can take it as is and get it off the plate so I can get the commission and they can get a great deal. You want to be one of those phone calls when they get that great opportunity. So Jonathan, talk us through the great opportunity that you got that probably was not a mass marketed deal, probably was a broker like, hey man, I got something. It ain't pretty, but I got a deal. So talk us through what you got.
Yeah, absolutely. So, I would say going back in the early days, just to kind of put some context behind this story, all our deals were off market. That's how we did. And then I would say the last 2 years, we've bought mostly on market deals, but kind of on market with a nuance, right? Like there's a problem to solve, or maybe the seller's a little more difficult to work with, or whatever the case may be. Something where they needed a qualified buyer, and we were able to get in. So the deal that we're going to chat about, the Parkside Apartments in Lubbock, when we went into beginning of 2024, and we were kind of ironing out what's our acquisition strategy. In my mind, there were 2 main approaches. What I was seeing in the market was that stabilized deals with new debt just did not work. You could underwrite one after another, after another, after another. It just was not working. And so that really left 2 options in my mind. One was deals with loan assumptions, which we've done 2 of those in the last 2 or 3 couple years now. And we can chat about that if we want to. But then the other was true, legitimate value add deals. Like when you read a multifamily book, textbook, like what you think of in multifamily. And so we started chasing some of those deals, and we're able to land one in Lubbock, Texas. Kind of going back to what you alluded to, it was technically an on-market deal, but we sort of had the in to go look at it before it ever went to market. So like the day it hit market, we're putting in an LOI. We were very aggressive with earnest money, with pricing, etc. Because we knew it was a great deal and we wanted to get it locked up before someone else got it. And funny story, initially we were outbid by one other person and they signed a contract with someone else, and that person just never wired their EMD. Like they were not a qualified buyer and they just didn't wire their EMD, right?
Wow.
And so, but then as soon as they fell out and the seller's like, oh crap, like it's not a guarantee I'm going to close just because I signed a contract, they came to us and we agreed to the same terms. So anyways,
I want to pause you for a second. Best ever listeners. Too many people that I talk to are like, oh, I can't get near the price or whatever. I'm not going to make the offer. Guys, make the offer, no matter what it is. Because I've had happen to me, what happened to Jonathan, to be second best. Like I put my offer in writing, somebody beat me on price, and then that person, for whatever it was, couldn't close. Maybe deal fell through. In Jonathan's case, got cold feet and didn't even wire their money. Right? You never know what's going to happen if you put it in writing. And I have many friends in this industry, including Jonathan, who have had deals come back and be second best. So never call it done until the other guy closes, because it might come back. So anyway, keep going, Jonathan. I just wanted to drive that point home for the listener.
That's really important. And I would put in that ultimately, like our closing price was, this is let's call it, we're in Texas, so we don't like to say pricing, but let's just call it a $10-ish million deal. And we were $1 million off on what they wanted. So,
wow.
The whisper price is just a starting point. It's not the end point.
Not anymore.
Yeah. So within our criteria, we're looking for like true value add. We're like untouched units and all that. So this property, mom and pop owners for 35 years.
Wow.
Self-managed with, practices that are not up to like our normal industry standard, minimal to no marketing for the property. Basically all classic units minus just what they had to do.
Did they have a handwritten for rent sign? Did they have a handwritten for rent sign?
They were not quite that level. They actually had real software they used to manage, which I think with 170 units, I don't know how you would get away without that.
I've seen deals handwritten for rent sign, like legal pad for the rent roll is like written on a legal pad.
We've bought some single page T12 handwritten kind of deals. This one was not quite that crazy, but it had a lot of the good components. And so that's how we knew. Matt was talking about your buy box. That's how we knew this is worth the price that we have it underwritten to. We need to be very aggressive with our offer and just get it locked up, because once it goes to market.
Did they have a Google pin drop for the property?
Ooh, that's a good question.
Well,
they were on Google. So I guess they did.
I've done a few deals that mom and pop owners didn't know how to use the magic internet box, that kind of thing. And didn't have a Google pin drop for the property, or it wasn't there. There was one that we did that didn't have one, and another one that we did that it had one, but the info was incorrect. And now they're like, I don't know why I'm not getting the phone calls. Right. And I'm not judging anybody. It's just that, like, at the end of the day, there's just technology's changed a lot in the last 10 years. And if you're an owner that's used to doing things another way, then maybe you haven't kept up with it, Well,
definitely every owner investor has their own objectives, right? And so like we took over this property at 68% occupancy.
Yeah. Wow.
And so this was our first bridge loan deal that we did. So it's pretty intimidating because it's, first time doing this big of a project, this much risk, I would say, on a project. But yeah, I think for the owners, people would ask me why would they let a property run like that? And the answer is, if you own something either free and clear or close to free and clear, you're making money at 70%, right? And so at that point, it's double the effort to keep a property running at 90 as opposed to 70. And so if you can just chill and make money at 70%, why are you doing more? Why are you going to put in double the effort, So that's usually what it comes down to.
Okay. So tell us that. So you got a off the market deal, mom and pop, not a mass marketed, property off the market, established a good relationship with the broker who gave you first look at it, all the things. What do you do? So now you get this bridge loan. You're at 68% occupancy, certainly not going to make a good living off of that, right? So what was the business plan to take it to the promised land, so to speak, to get idea? Because I see in the notes here you got it up to 95% occupancy. Talk us through how you did it. What did you have to mitigate? What was it like taking over? I can only imagine taking over a property that's been mom and pop managed for 35 years, and these tenants that love mom and pop, and mom and pop were like family to them, and all of a sudden there's this young whippersnapper coming in, right?
Yeah.
How did it go?
Yeah. So first of all, I would just say to the listeners, like we're probably a little bit unconventional as asset managers. We are extremely hands-on. And so because this property is in Lubbock, it's our first time doing this. And our property manager, this particular one we had not worked with before. We literally rented an Airbnb in Lubbock and we moved to Lubbock for 3 months. Because that's how seriously we take running deals. And so I'm not saying that you should do that or you have to do it. I'm just telling you what we did.
You can do whatever it takes. That's like underscore that. You don't have to move to Lubbock or to move to where your deal is.
You have to do what you need to get to where you told your investors you're going to be.
Love it. I love that.
Well, and I would say, we kind of had some hints from this third party manager, and maybe we can chat third party management here in a minute, but we kind of had some hints that they were not as solid as what we had originally thought they were. And so that was part of what informed that decision. It wasn't like that was necessarily a day one plan. But taking over a property like that, the biggest challenge is prioritizing tasks. Like day one, you need marketing. We were rebranding. You need signage. You need a landscape company. You need trash. You need utilities. Like there's a list of 30 things. And in a perfect world, your property manager would come in and do all that.
And they got all
Let me tell you, on heavy value add, they're not going to get it done in the time frame that you need to. And it was just like every day was wake up, kind of have a stand-up meeting, myself, Paula, and the other thing I didn't mention, we took over this property. The only staff we had at the time was a leasing agent. We had no maintenance day one. We had no one else in the office. Like it was bare bones. And that was kind of one of the reasons we had a hint that probably our third party was not going to do what we needed them to, because they weren't prepared for the closing like what we would have liked them to be. And so that was another reason that we were there. But, it's kind of like day one, we're trying to find a team. It was just a lot.
What was your straw that broke what was your first sign of this PM's not going to make it? Maybe you've already covered that. On what your first sign that they're not going to make it, and then what was the straw that broke it? Like, okay, that's it, I'm done. I need to find a new PM.
Yeah, so I would say, obviously the appropriate staffing at closing was a big one.
That's a good sign. But what was okay, that's it. This is the last straw.
Yeah. So we went right home after closing, and probably the straw that caused us to kind of turn around, come back was, one of the first things a PM should do is get all the utilities switched over. And we had gone through that, rehearsed that going into closing. And so a couple days after closing, hey, can you confirm we have all the utilities switched over? Oh, we're working on it. It'll be done in a day or two. A couple days later, hey, are we all switched over on everything? Oh, we're working on it. And then at some point in that week, they said, yeah, we've done it. And then we found out through other means they had not actually done it. Yeah. And that was the point where it's like, if this is one thing that we have sight to that's not done, what else is not done? So I would say that was the straw.
Wow. Yeah. So then what'd you do? Did you fire them and bring another third party in?
We did, but we played it once again. I'm not telling your listeners to do this right or wrong, because if you're in this situation, you just have to figure out your own path. But our perspective was, by that point, we knew the property, the business plan better than they did, better than probably anyone at this point.
Well, you're living down the road. You're living around the corner from the property in Lubbock, right? So you're on site more than they are, right?
Exactly. And we knew what needed to be done. We had one thing that we did right on this is we actually partnered with a guy who owns a construction company in Lubbock.
Right.
He was wanting to start being an investor. And so some of that construction piece, he was able to help us with some of that. In addition, we have technical boots on the ground there, even when we're not there like today, right? But yeah, and so at that point, our strategy was we need to get this thing to 90 and then switch PM companies. And so that's what we did. We said, it's just, there's too much turbulence going through even a relatively smooth transition. We need to work with the team that we selected get it to 90. And then once we're stable, we can do that. And so that was how we played it out. And kind of in the plot twist, because I know we don't want to take all day for this story, we closed July 19th of last year. We hit 90% Thanksgiving week. And then we went home like the first week of December.
There you go. Okay.
That's kind of the general timeline on the project.
Now, did you were you just leasing the classics as is, or are you upgrading to like a renovated standard with the vacancies you had?
So we did both. We had, I think it was you guys can do the math, 45 to 50 vacant units day one, something in that range.
A lot. Yeah.
So we identified maybe, let's call it, I think it was about 15 or 17 that were like classic, in good condition, already cleaned. So those went out to market day one at classic rates. And then the rest of them, we started from easiest to most difficult and started doing those upgrades. And then, probably the first one took a month from when we closed to get the first one out the door. But then after that, they were just progressively rolling out the door, and we were renting those at the better rates. And the other thing that was nice is by the time those upgraded ones were ready, we had improved a lot of the exterior. Like we had some temporary signs up. We had the landscaping cleaned up. We had the trash situation under control. Yeah. So it was a little bit easier to ask for those pro forma rents at that point.
Yeah. I mean, perception's reality. And also you can't, you got to like monitor the first impression your property makes. So you can't have like a nicely beautiful renovated unit with granite and stainless steel appliances, and the property still looks dated on the outside. You got to do both. So I love that you guys had the wherewithal to do that. So how's it going now? So now fast forward to today. So that property, still sitting above 90. Have you refied it yet? Are you still in the middle of that? Where are you at today with the property?
Yeah, so we're still over 90. We've been around 93, and it's been hard to push above that. We're trying to get our goal is to be 95. I mean, at that point, you're kind of getting the best leverage you're going to get on the refi. So trying to get up to that 95 mark, and pretty close to it. Now that we're in the summertime, I think that we'll be able to maintain that without as much difficulty. We've improved a ton of the property. It shows so much better. It's, a place you're actually proud when you pull up, I would say. We have a great team. I literally think, obviously I'm biased, we have one of the strongest, C-class apartment teams in Lubbock. Yeah. In terms of our maintenance, our property manager, et cetera. So that's really cool. And a lot of our residents, you asked about, the ones that are kind of used to maybe the more lax rules or the mom and pop style. Obviously there's always some that are challenging to work with, but when they see how much the property's like cleaned up, and it's like, oh, the trash is picked up and you've trimmed all the landscaping, and you're doing this and that. Oh, and my rent's only going up $25 on renewal. Like that's a win. It's my home. So it's actually gone pretty well. Working on refining this fall. That's kind of in works. A lot of the game right now with refis is just playing ball with the tenure, and just kind of hanging out. And so, our strategy is like, we're going to get the app in, get the third parties done. And then at that point, we're just going to hang out until we decide we want to lock. So
it's
who knows what day that will be.
I remember years ago, pre-COVID and right after COVID, like you would lock as soon as you got your application in, because why not? And rates are likely going to go a little bit higher than they would go lower. So now it's like people don't lock until they absolutely have to, because it's like you cross your fingers and you hope that the wind blows the right way, and rates might drop a quarter point or something like that. So interesting. We're all doing the same thing. Interesting strategy though. So you've your issues with management have been up and down, like everybody else has had issues with property management. I get it. Have you ever thought about going in-house to just manage it yourself?
We have thought about it quite a bit, because we're in this game for the long term. This is our kind of permanent business. We have two challenges that we have to solve currently. Mm-hmm. One is we're very spread out market wise, which is not conducive to having third party. We probably have the unit count now to do it, but it's just when it's spread out across multiple markets, it's difficult. The second challenge is that, particularly with our assets in Oklahoma, which is about half our portfolio, we actually have a really great third-party manager there, to the point where, like, if we had them everywhere, we wouldn't even probably do third-party. And so it's kind of this balance right now of like, do we start it and just do stuff in Texas? Do we only buy in Oklahoma? Like, there's several ways you could go here, but I suspect 5 years down the road, we'll probably vertically integrate just based on what I see a lot of really competent operators doing that. And I think you guys have done that,
Yeah,
right, Matt?
about a year ago, we took
Okay.
management
How's it
in-house.
going?
I mean, when we did it, we were like, okay, we just can't tolerate, 6 out of 10, just sometimes things go well, sometimes things did not go well. And they were not going well. They really went down the rabbit hole quickly. This is for our
Hmm.
portfolio we had in Kentucky. And we had a really, really bad property manager there. And we were I wasn't happy, with their day-to-day performance. They had one property that they had 5 different site managers at in a year.
Wow.
And that they just kept moving them, or, oh, they quit. Oh, this person, moved, we had to move them somewhere else or whatever. So we kept complaining and, threatening and giving them 90-day action letters and all these other things. And it all just fell on deaf ears. And we said, you know what? If you look at property management with a reasonable sized portfolio, the properties themselves, so for your 171 unit, it's likely paying its payroll, meaning like
Yep.
that.
Correct.
And this is for the best ever listeners to understand how larger assets tend to work. Like even above 80 units, you're going to pay payroll out of the property cash flow anyway. And so what you really need is just a management strategy and regional management efforts that sit above those site managers, and just a good hiring protocol and back end accounting. And that's probably the biggest thing to figure out is there's so much accounting that has to happen
Yeah.
in multifamily real estate. And people don't realize, oh, I'll just hire a bookkeeper. No, whatever bookkeeper you're using now is not going to run a reasonable sized multifamily portfolio, right? So that's probably Jonathan, the biggest hurdle we had to get over. We ended up hiring a fractional accounting firm to
Okay.
do the accounting work, because if you look at big PM companies that are managing 4, 5, 10,000 doors, they have a whole army of bookkeepers and accountants in house to keep all the books
Right.
for all the assets, because there's so many. Like each rent needs to get booked, and all the bills and all the everything. There's a lot. So that's probably getting our head around how to handle the accounting side, and then who would be the leaders of those, the regional team above all the site managers. Those are probably the 2 big questions we had to answer. Once we got those done, or those questions answered, and we, handled all the skeletons that came out of the closet, as soon as you fire the property manager, you realize how bad of a job they've actually been doing, because now your eyes
Hmm.
are on it. And so we had to mitigate all these skeletons that they, had not told us about. Everything had been swept under the rug. Took us a while to deal with that. Once that was done, our occupancy has been up. Our morale at our properties, both among our tenants and our
Hmm.
staff, is way, way higher, because we're controlling the culture. You're not going to make huge money as a property manager, but what you are going to do is control the culture of your company and know you want to handle your residents the right way, to know that you're going to lead the right way, that you're going to have the right initiatives for leasing, and and all those things are all going to be under your control, versus somebody else, you kind of playing telephone through them to how you want the asset to be run. So
And
overall, it's going really well.
how does your structure? You have a regional type role
Yes.
above your property managers, and then you guys are still working as basically the asset managers above them.
Yeah. We set up another
Okay.
company. So my company is called the
Yeah.
DeRosa Group, and you
Right.
need to run it like another business, because it is, right. The asset
Right.
manager's goals are like, let's talk about it. What's the asset manager's goals in your eyes, right?
Yeah, I mean, the way I explain it to our investors is it's making sure the third party PM is doing what it is that we've told them to
Yeah.
do, and then anything above that related to running the
Mhm.
property, executing the business plan, right? So anything that's outside of the PM's umbrella but still pertinent to the project, we would be responsible for.
It's you underscore what you just said, executing the business plan. And I mean, if you look at the AM, there's certain KPIs the AM has, right? I would suggest that the bottom line NOI, the net operating income for a property, is the asset manager's number one KPI. And if the NOI is healthy, that means that leasing is happening. That means that rents are being collected. That means that bills are being paid and bills are being mitigated and minimized as best you can, right? And
Right.
if my NOI is on target and it's growing, then whatever the plan is, sell the asset, refinance it, whatever it may be, the AM can control that by controlling an OI, right? On the other side of it, the property manager is a whole nother. You cannot hold your property manager accountable to NOI. You can't do that. The property
Mhm.
manager has a whole nother set of priorities, or they should. Those are things like, lease, successful leases in a month. Like, am I dissolving vacancy? Am I turning units properly? Am I pushing? Yeah,
Collections.
keeping to, oh goodness, delinquency collections, right? The AM, you could say, well, it's their job to make sure things are being, collect. Not really. They're really there to make sure the property manager's collecting the rent, doing their job on time. I'll give you a few more that people don't think about. Work orders, right? A property manager's job is to make sure that work orders get done in a timely fashion. Now, if you want to be like a microscope PM company like we are, there are parameters and KPIs around how quickly a work order gets done, right? And so AM, it's well beyond their realm of their bubble, right?
Right.
And so we ended up starting a separate PM company that had all those things called DeRosa Living, and we brought over an executive from a PM company that we had worked with. We hired her away. She was a regional manager for a PM company in North Carolina. We hired her away and made her the president of our PM company.
Yeah.
And with taking a property management fee on all the assets we had, you're making enough money that you can afford to pay her salary, right?
Exactly.
Because
Yeah.
all that PM fee now comes into house. But I'll tell you, Jonathan, just between you and me, there is a sizing break point. Like it'd be very tough for you to do for just your Lubbock deal.
Right. Exactly.
Build
What
out
What do you say
pay
that
team.
sizing break point is? A lot of people say maybe 1,000 units.
I'd say so. I'd say it isn't going to be 1,000 units. I'd say it's like 500 to 600 units in one location, right? Because if you're like 1,000 units, but you're scattered site, and you got 200 units in Phoenix and 200 units in Tulsa and 200 units up in Topeka, Kansas, or whatever, that's gonna be very tough to do because you can't have a regional sit over all that, right? They're going to be on an airplane all the time, and that's not going to work. So if you've got 500 to 1,000 units in one geography that a regional can effectively go and visit at least once a week, if not twice a week, then you could have an effective equation, And there's
Yeah.
solutions like third-party bookkeeping services you can use. You need insurance, you need healthcare, Jonathan. All this stuff.
HR.
Oh
All
yeah,
things HR.
HR. But there's companies that'll do that on a fractional basis for you. And that it's a big new world out there with what you can
Yeah.
get done without having to hire, high dollar single employees. You can hire fractional help quite a bit for these kinds of things. So that's the break number. It's not for the faint of heart, but it's been good for us in the long term.
That's cool.
Yeah. Yeah. Thank you. So it's there for you. And maybe my suggestion would be, and this is for the best ever listeners too, if you got a third party PM team that's working, like for you there in Oklahoma, no reason to let them go. I mean, maybe if I were you,
Exactly.
I'd try and convince them to take over your Texas portfolio. Convince them to, hey, wouldn't you love to expand to Texas? And
Yeah.
have you had that
Exactly.
conversation?
Not yet. I think we need to consolidate a little more. I mean, going forward, we're probably going to be Dallas buyers. I think now there's a lot more opportunities there, and I think kind of once we have that portfolio together there, where they can hire a regional over that one area,
Yeah.
then it probably makes more. It's probably a more sellable argument at that point.
That's why your PM is going to be reluctant to move into a market as well, best ever listeners. And now, like, they don't have regional management presence. And just if your PM company, guys, is like, oh yeah, I'll come manage your 40 unit out of state, be leery, because if they don't have the infrastructure, and the team to come run that for you, they're going to run it into the ground. You want to ask the right questions. Just getting your PM company to say yes, I will run that for you is maybe not the. You probably should ask other questions on how they're going to run
Exactly.
it. Yeah.
Absolutely.
Yeah. Cool. So Jonathan, it's been an interesting conversation. I really see your growth trajectory. You tell me what's next for Apogee and your company. Where are you guys heading? What's the next mountain you guys are climbing? Where are you in a couple of years?
Yeah, it probably doesn't feel like it, but I actually think now's a great time in our business. We already talked a little bit about how difficult it was to break in and find deals, and now it's kind of pivoted to where there's good deals out there. If you're an experienced operator, if you're willing to work hard, put in the effort. So I'm actually excited about the next couple years. Our markets we're focusing on now are strictly Dallas, Fort Worth, and Oklahoma City. A lot of different reasons behind that, but we are kind of honing in and focusing and trying to build our portfolios in those two markets. So working a lot on that. Our commitment to our investors has always been we only take on a new project when we feel really comfortable with our current projects. And so we just go deal by deal. And we don't necessarily have a metric of like, well, we have to buy 500 units this year or whatever. It's more of when we're ready for the next deal, we're going to go find it. And that's worked really well for us.
That's great. That's great. I believe in being market focused too, in that. So I think that's a great method to scale. Well, thank you for sharing all your tips on deal acquisitions and on the markets that you're in and on your journey. For those who want to reach out to you to hear more, how do they do that?
Yeah, the best thing is just check out our website. We've got contact forms there and stuff. It's Apogee MFC, like multifamilycapital.com, and check out our resources and send me a message.
And these Apogee is APOGEE, right?
Correct. Yes.
Okay. Apogee. What's Apogee? Where'd that name come from?
That's a great question. Yeah. So in aerospace engineering, which is my background, apogee is like a very technical term. It has to do with like the highest point that a satellite or something orbiting can reach. But the more colloquial definition of apogee in the dictionary is like the summit or, kind of pinnacle point that something can reach. And so for us, apogee kind of ties my old career in with what we're doing now, which is helping investors reach their financial potential, right? That's what real estate investing is about. It's about reaching that wealth building potential through real estate investing.
I love that. Thank you. I love company names that have a good meaning or a company mission that's really inspiring and everything like that. So one more time, Apogee MFC.
MFC, Multifamily Capital. Yep.
ApogeeMFC.com. Check out Jonathan Nichols. Star on the rise. Lots of great stuff happening in your world, Jonathan. I appreciate you joining us on Best Ever CRE today.
Thanks for having me, Matt.
Guys, great show with Jonathan Nichols. I really appreciate him joining us on the show and hearing about growth and hearing about like just really interesting acquisition strategies. Hope you guys got some tips on how to get brokers' attention and about just submitting offers and staying market centric and things like that. And perhaps when it's time to shift away from a PM company. Great episode. I enjoyed it myself too. Come see me, guys, every Friday where Next Level CRE comes out. I hope you guys can see me then. And I hope you guys can also come see me in the Best Ever community by going to bestevercre.com/community. It's free. Check it out. I'll see you there. And I will see you guys next week for Next Level CRE. Take care.